Let's start by looking back for a moment. I know there's a lot of stuff coming up this week. The trade balance on Friday, whether it's nominal or real, it was a shocker and the worst ever. And the effect on the currency as a result.
Hi, David. Yes, last week's data really did, I think, take the market by surprise and was, even worse, I think, than the most than the most bearish forecasts that were out there. So in the event, above 20 billion, and certainly, as you mentioned, the largest on record. So partly it was a combination of the struggles and strikes that we've seen in the mining sector that really impacted on exports there, but also this unexpected huge surge in import in machinery. It seems to be related to the infrastructure drive, and from what I understand, particularly related to some equipment imported by Eskom, but that, I don't think that has really been verified. But when it comes to imports of that kind, they really can sway the balance and impact the numbers quite strongly. And of course, there's no way to kind of forecast that. They do tend to be lumpy and erratic. So I think it was just a combination of factors that really impacted and created such a huge deficit on the trade account. And of course, the rand reacted negatively, as one would imagine. It had seemed to be making some ground earlier in the week, and then pulled back almost entirely after the news of that data broke.
Yeah. What did you make of the numbers, Ian? I mean, as Nomvuyo highlighted, it took the market by surprise. We had exports up 7.8% month on month, but imports jumping nearly 17%, and quite grave implications for that local unit. We've seen further weakness filtered through this morning still.
Absolutely, and this is going to be ongoing. We still haven't seen much development from President Zuma's infrastructure development promises that were made. But if that gets into action, just looking for a year or two ahead, there's going to be massive imports of capital equipment. This is going to have an ongoing effect on the trade account, and I think that then comes through to the current account. And we're running the risk of pushing our trade account, our current account deficit over 6%, which is looked as the benchmark worst that we should get to.
And it's very dangerous territory,
yes,
because as Eugene highlighted a little earlier, we're depending on those investment inflows to actually fund it.
Exactly, and then watch the ratings agencies having a field day again, pointing more fingers at us, saying, we warned you about a downgrade, and it's going to come. And then what is going to happen to the rand? It's going to be harder to get funding, it's going to put more pressure on that side, and I think the rand will remain under pressure, certainly through the first half of next year. And that's bad from an inflation point of view.
Those horrible ratings agencies, we just wish they weren't there. And as we said earlier, less and less business as this month goes on, and more politics. But the Reserve Bank, at least in the excellence of its reporting, is always a great reassurance, and their quarterly bulletins coming up, Nomvuyo. What are you expecting there?
Yes, David, it's one of the, highlights of the local economic calendar, because it presents a wealth of quarterly data. So there are a couple of things that we'll be looking for. First and foremost, I think, as Mr. Cruickshanks pointed out, the current account remains of paramount importance, and we'll get the third quarter data out of there. Luckily, this shock trade deficit for October won't be featured in the quarter three numbers, but nevertheless, we're expecting it, expecting that the current account probably remained under pressure, as you saw the trade balance numbers. Even for September and the preceding months, weren't especially stellar. So we're expecting another number in excess of a 6% deficit as far as the current account is concerned. We'll also be focusing or looking out especially for what's been happening on the fixed investment side. As you know, as we were talking about the impact on the trade balance and the fact that government's infrastructure drive really is still set to kick into its highest gear, we'll be looking to see for evidence of whether fixed investment expenditure, particularly by government and state-owned enterprises, is picking up, and also importantly what's been happening in the private sector. We saw business confidence somewhat stabilize in the fourth quarter, but it has remained relatively weak, and so with private sector investment being the mainstay of investment in South Africa, I think that's also going to be one of the key indicators, and certainly will point to the health of investment growth going forward.
It's interesting, Nomvuyo, because it seems like we're going to have all eyes on the data points locally, and that impacting the local unit and the kind of currency moves we're seeing on home ground in a bigger way than what we're seeing play out internationally. And I highlight this because the rand weakness that's continuing to come through this morning, despite the fact that we've had the euro rising to a 6-week high against the dollar on the back of those very encouraging numbers, it seems, out of China this morning.
Yes, absolutely. It does seem at this point that the rand really is focusing more on domestic matters, and is likely to remain that way as we head into, the Mangaung. So certainly it does seem that domestic factors besides the data, interest rate decisions and politics certainly are going to be the key themes for the rand, and unfortunately it does seem to point to the potential for further rand weakness at this point rather than rand strength.